So
proper allocation
what are
to
you leaving
Joe's.
on? What are the favorites that are too good to let go?
Well, I have my core book, my Joe, that's going nowhere. My Cornerstone, I've added some Valaris in Q1 when it came out of bankruptcy. We talked about that a few months ago when it was at 21, and here we are at 29. I've really legged into energy in the last couple of months. When basically Larry Fink decided that oil was going to 300 and he was the man to do it. I took the memo and kind of internalized it, and I bought the back end of the curve, or maybe the mid of the curve. I'm in 23 and 25 paper. But I mean, I really do think that Larry Fink and some of these other guys got it in their head that if you want to have a pivot to sustainable energy, the best way to do it is to take oil to 300, and that accelerates the transition a lot better than a bunch of lobbyists getting congressmen to pass subsidies.
So do you think that they've actually decided that? Like, do you honestly believe that that's their?
Yeah. I mean, I didn't want to say that last time when we talked about ESG equals, energy stops growing. But the more I think about it.
I never heard of that. That's a great line.
Oh, really? I thought we discussed that.
No, I don't. Well, or I wasn't listening. Oh, yeah. You know what? I think Patrick did the last one, which shows you that I don't listen. So I've.
But no, I really do think that some of these guys like CalPERS and BlackRock and a few of the other guys, they got down and they said, look, let's vote for these environmentalist activists. Let's ensure that no oil company wants to produce oil anymore, because a board member is a pretty cushy job. You do very little and they pay you too much. And so they're going to force, the Exxons of the world to build windmills and solar panels instead of drilling. And by restricting the supply side, they're going to take oil to 300, which will, let the free market solve for the energy transition.
So I'm not so sure that they've thought it out as much as you think they have. Like, for example, I saw Biden, what OPEC decided they didn't come up with an agreement. They didn't pump any more. Oil went up, and he's already panicking. He's already like, holy shit, look what's happening here. We need oil down. And I kind of almost think that these idiots have just said to themselves, we can have it both ways. We can have these companies not pump any more oil, and somehow magically we're just going to, if we don't produce any more oil, the price where everyone's going to move. And you and I have, made the leap in terms of understanding that, yes, by doing that, you raise prices, which then encourages other things. But I think you're giving all these guys too much credit.
Well, I mean, Larry Fink's a sharp guy. He understands how the free market works. Biden's major policy decision all year was which flavor of ice cream to order, and then he kind of screwed it all up. I mean, you saw that all the cameras went there this week, and he had a brain freeze from the ice cream, and no one noticed the difference.
Well, no, the real joke is he's impervious to brain freezes.
In any case, I don't think he's making policy decisions. I think cause and effect will surprise a lot of people on the left. But no, I do think that this is premeditated and is designed to accelerate the shift. Because, look, how does a guy who's a fiduciary, vote his shares in a proxy for something that destroys capital? I mean, it makes no other sense anyway. But let's not go too deep into this. Let's just accept the fact that oil is going a lot higher than where the front of the curve is today.
Okay.
The front of the curve is the piece that OPEC moves around, and the UAE has their day, and then Biden has his day. Everyone takes a chance, kind of. It's kind of like a soccer ball. They just kind of kick it back and forth. But the back of the curve, that's like zero delta because it's gone nowhere while the front went 20 points. But I think that's the better place in the curve to play, because I don't think, like right now, we're going to work through some excess inventory still. I think it's the back of the curve where this time next year, guys have this oh shit moment where all the stimulus means that oil grows 3 a year versus 1 to 2 a year, and India and China really get into the sweet spot of their S curve in terms of oil consumption. And people realize that you can't bring on supply fast. And then the true oh shit moment is when OPEC says, yeah, man, we're going 100%. We don't know what to do now.
Right. When the world is sucking up everything that everyone can pump and it's still not enough.
Yeah, it's kind of like in 2008, OPEC had this oh shit moment, and oil went from what is it like 75 to 150 in like 3 months.
Yeah.
So I want to be further back in the curve because look, when oil went to zero last year, the back of the curve, the 25s were in the 40s,
Right.
and so famous last words, but I'm risking like $10 ish to see if I can make 100 or maybe 200. And I'm playing this with the futures. I'm playing with call options on the 25s, and my favorite trade really is the 90 by 100 call spread for 23. I put that on at 63 cents. It's 70 cents bid right now, but I put that on at 63 cents, and it pays off at $10 if oil's over 100. And it's a 15 bagger for 2 years, which isn't so bad.
Yeah, but
And
1 second, you said it's 63 cents and it's now 70. You put it on at 63 and a 70% bid. Doesn't count when it's your bid too, Kuppy.
hey, I own the whole open interest.
It's like when I cleaned out all the offerings and then I made a bid.
Okay, fine. This is a level 3 asset, but the point being that someone plugged me when I bid for it, and
I'm just kidding. You're like that guy Hunter that was trading 4 year out, March, April, that gas spreads, and I'm up 50% this year.
He was up like 4 ticks on a calendar,
Exactly until JP Morgan and that other really shrewd guy laid him out. I can't remember the other guy's name.
Against him. It was like a 4 year out calendar that no one traded. He was, what was he, 100,000 of the 100,003 contracts or something?
Yeah, it was unbelievable. And these guys figured it out. They just laid them out. Anyways, it was more complicated than that. And there's actually, for those that are interested, there's a terrific podcast of that fellow that was on the other side of that trade. And he is one of the sharpest, nicest guys out there. And I highly recommend everyone, track that down. I've forgotten it. I can't remember the guy's name or anything like that.
Too, the Amaranth book, where they walk you through all his positioning.
Oh,
and when he had his like oh shit moment, where basically the risk department one day actually did their job, and they had this like, oh, we have to unwind this. And JP Morgan, which was making a market like 3 ticks wide, put it like $2 wide.
Oh, what do you want to do now? I remember being at the bank one time and they came to me and they said, if you had to take this position off, who could you trade with? And I was like, what do you mean? Like, I'm like 40% of the open interest. This was when I was doing index ARP. I was like, there's nobody to trade with. I said, there's probably one guy out there. And if I trade with him, I don't want to be on the other side of his trade. Like, the reality is that at a certain point, you just have to wait it out. And at a certain size. Okay, so let's go back to the topic on hand here. Oil, you love it. You're long
let's
all
talk about these call spreads again, because the most I'm going to lose is 63 cents if they all go to call spread heaven. And I could look at this in Jan of 23 when there's still a whole lot of theta left, and I think these are like 40 to 50 cent spreads. So I'm really risking like 10 to 20 cents. Famous last words. But there's going to be some time premium in these spreads still at the start of the year, and we could reevaluate what the world looks like. I mean, if everyone dies of Delta, then, it's probably a bad trade.
Yeah. Well, it's the lambda, I think, is now what we got to worry about. Why don't you explain to people what the lambda, those guys are bad news. Why don't you explain to people what a call spread is and how you do it, just kind of for those who aren't, familiar with the terms.
A call spread means you're buying one call and selling a different call. And when you long the call spread like me, I'm long the DEES 2390s and I'm selling the DEES 23 So same months, different strikes.
Right.
You can obviously put this on with calendars. You could put this on with ratios where you're leaning net long or short. But I'm not that smart. I'm just plain vanilla.
Right. So you're long the $90 call and short the $100 call. So the most that you can make of it at expiry, if it's above 100, is the $10, but you're paying 63 cents or now it's 70 bid. And so you're paying that, and that's the most you can lose. And your upside is the $9.30 or whatever that you can make.
Correct. So, and I mean, when you can make a 15 bagger, it's pretty good. I mean, I think the market's pricing out a 1 in 15 chance of this going off. You'd probably correct me with your quant logic, but in my mind, that's how we're going to price it out. And I think it's better than a 50-50. So it just seems mispriced to me.
Yeah, no, I hear you. It's interesting. And, as your risk manager, Kuppy, I have to ask, what percentage of the open interest are you? Don't answer that. Don't answer that.
I've told a few of my friends about it, which
Yeah.
is, good practice after you're long yourself. And I think between myself and about 10 people, we're the open interest.
That's right.